So now I sent a Facebook thing to LeBron James because we voted him Male Athlete of the Year, and I figured, hey, maybe he'll come on the show.
You voted in that?
Yeah.
That was your, what'd you call it?
We did the year-end in sports. That's fun.
What's the guys in the morning, Murph and Mackey? They do the Murph and Mackeys.
We're from Mackey's.
The Murph and Mackeys. What's the name of your show again? The
Sports Econ 101. So we gotta come up with that.
we do the Sports Econies.
Sports Economies, that's it. All right, so.
Oh my gosh. Hello, hello, hello.
Yeah.
Am I here? Yes, I am.
Yes, you are. Okay.
Oh man, barely alive.
My
stuff is for next hour. My
Okay, that's good.
BOI articles.
Good.
And then we got Robert coming, right?
We have Robert Spinoza. He's got some stuff, and we have this guest. So it'll be sort of fun.
Oh, what's the guest? I forgot to look that. Pull any of his stuff up.
What goes on in the corner office?
What?
It's actually more of it's not a sexual thing. It sounds like it's more of a kind of an interesting. I've got some. Before we start, I'll give you some of that stuff. Oh yeah, and then so they gave us a little. I don't say a bombshell drop, but I would have thought not next week, but the week after, December or January 2nd would have been okay. It's after the holidays, right?
Okay, yeah.
And no. They are saying that they need us to. They need it by noon.
Right, I saw that email
Yeah.
coming. I just figured.
So, which would mean we need to do both shows, like 10 to 11, 11 to 12. Think you can do that?
Yeah, I guess. I mean, the only thing I was thinking of is it's that one day back. I don't know what kind of emergencies I might have, but I might not have anything. It might just be so quiet that it doesn't really matter. But what day is that again? Now I'm getting confused.
Still Thursday.
So it's. Oh, right. So it's
Yeah.
Thursday
It's just earlier,
the
that's all.
2nd.
Yeah.
So it's the 2nd and the 3rd, which is when a lot of people are going to, anxiously be wanting to get back into action again. But yeah, I guess I'll just have to block out those 2 hours. So.
Okay, Kramer says he'll be here. So
Really?
he'll film, yeah. All right. Figure out things. Okay, so we'll get into.
to bring my water? My tissues. The water, I guess
Yeah,
I
I
can
got
do
tissue.
that. I got tissues too. I got it in my jacket. Should you bring them? I may not need them. All right. Stuck in case.
Yes, I did. Okay.
Started it?
Yeah.
I can pick my nose.
Yeah, there you go. Well, what happens is I do the thing, and then what I do is I cut off in the beginning until we start the show. So you say anything you want, you do all this kind of stuff, and it won't show up. All right, ready?
Show must go on.
Yes, it must.
Okay, yeah, they should give me a call myself. 415-203-5.
Welcome to Mortgage Investing 101, the show where we discuss high-yield real estate mortgage-backed investment opportunities. I'm Edward Brown, your host, and I'm proud to introduce my co-host, Mark Hoff, president of Pacific Private Money, one of the fastest-growing private mortgage investment firms in Northern California. Our goal on this show is to provide information and to increase your awareness of these important alternative investment strategies where you can earn secured high yields using your savings or IRA accounts. Annual yields of 8% or more are not uncommon using these strategies we're going to discuss in today's show. And if you like what you hear, please call Pacific Private Money at 415-883-2150 for more information, or go to pacificprivatemoney.com. And you can also leave your name and your question there, and we'll get back to you after the show.
Absolutely.
Okay, for fun, we're also going to have trivia contests before commercial breaks, where the first 3 callers with the correct answer will win a free 3-day, 2-night vacation.
I'm on pins and needles, wondering what the topic's going to be for today.
It's actually kind of a fun one. The vacations are not sponsored by the radio station, but by Lighthouse Resort and Marina, located 1 hour northeast of San Francisco. And the vacations are free. Lighthouse is only requesting a $75 house cleaning fee. Check them out at lighthouseforfun.com. Today's trivia theme is movies with colors in the name. That'll be kind of fun.
Interesting. All right, that'll be fun.
Okay, now, Mark, the name of the show is Mortgage Investing 101. What are we going to tell the audience today?
Well, we're going to talk about how you, as a saver, saving up for retirement, and a lot of people who listen to our show are people like you and I, Edward. We're in the baby boomer, yield. The people born. What was the start?
1946 to 1964.
Something. Yeah. That's amazing. You and I were born right around that 1960 mark, and so we're not that close to retirement yet, but we're looking ahead and going, gosh, we've spent the last 10 years in a near zero interest rate environment, and the stock market's been up, it's been down. We know what happened to real estate in 2007, and so the stark reality is that most people are not on track to retire successfully right now if they had to retire today, and that's thanks to, or no thanks to, near zero savings rates, near zero CD rates. The bond market's been really low, and the stocks have been, the stock market right now has about reached where it was adjusted for inflation when it hit a high in 2000 and, oh darn, another year just escaped me, but a long time ago, 10 years ago.
But it's interesting, the
2004, I think it was, wasn't it?
No, I think 2005, maybe 2006. But a lot of people talk about cash as king, but actually, what I think is king right is income. Income is king because that's what you have to live on.
Absolutely, and so we're going to talk about an alternative investment strategy that we are calling mortgage investing, but it goes by a lot of names. It's sometimes called private lending, sometimes called trust deed investing. It's also investing in vehicles like mortgage pool funds, which we're going to get into in a big way in this show today. But it's investing in a product whose income and security is based on loans secured by real estate. And you can earn easily 8% or more secured and insured with your savings or self-directed IRA accounts using these mortgage investing strategies that we're going to talk about today. And it's funny. It's we're nearing Christmas. It's we're in the second half of December here, and I can't tell you how many people I talk to on the phones right around the second and certainly by the third week of December. And when I'm talking to them, I'm trying to set up a meeting, or I want to talk about them with them about retirement and our particular retirement instruments. Oftentimes, people will say, "Oh, that sounds really interesting. Why don't you get a hold of me after the holidays?" There's this
after I spent all my money.
Right. Well, there's this mindset that people tend to go into in December, where it's an inertia. And now some people truly, they've worked hard all year. They really have prepared to go on either a real vacation or maybe a mental vacation in the last 2 weeks of December. But what better gift could you make for yourself, create for yourself, buy for yourself, invest for yourself than in an investment strategy that can pay you on your retirement savings 8% or more? And that's what we're really going to talk about today is how do we do that? What is this vehicle that we call mortgage investing? There's actually a couple of different vehicles that you can do. We'll get into that. But what is it? Is it risky? It sounds like it must be risky. How can you offer 8% or more on your savings if it doesn't have a tremendously or significantly higher risk than, say, a CD or bonds?
Well, I was going to ask you that question, but since you asked yourself that question, why don't you answer it?
Well, again, there's the name of the show, Mortgage Investing 101. And before we get too far along, you can listen to this broadcast or past broadcasts of Mortgage Investing 101. We've been doing the show now for going on 5 months. And we have a website. The radio show has its own website, mortgageinvesting101.com. That's mortgageinvesting101.com, of course, all one word. And it's a very simple website. It's really, for the most part, it's one where we host all of our podcasts. So you can go listen to any one of our 1-hour shows from the last 3 months. And we tend not to do the same show each week. We tend to get into slightly different topics, but we'll try to cover the gamut today, as we normally do, of the nuances of what is mortgage investing and how do you get in on it, and what are the risks and what are some of the other factors that make mortgage investing stand out among the various strategies that are at your disposal.
And I know in the past you've talked about it being the best kept secret, and you've also said it's not a secret anymore, and I can attest to that because we'll continue on for a bit. And remind me when we come back from break. We're not going to a break yet. When we come back from break, I'll tell you a story about how it's not a secret anymore. Remind me about
Well,
that.
Edward's absolutely correct. It's been called by many financial writers one of the best kept secrets in investing today. And the reason it's a secret is because you cannot buy or invest in these mortgage-backed investments through your financial planner generally, or your stockbroker. It's not an investment like stocks or bonds, which are publicly traded and are things that you can buy from any broker. These are generally only available through the real estate sector, either through a licensed real estate broker or from a California finance lender, and they are essentially what you're doing is you're being the bank. It's private lending. Let me back up and tell you exactly what we do at Pacific Private Money, who is the sponsor of this show, Mortgage Investing 101. At Pacific Private Money, we make loans to real estate investors, and we've been doing it since 2008. We have, before that, we've got 20 plus years in the real estate investment business. But after 2008, when the real estate and mortgage meltdown occurred, we realized that banks had essentially pulled out of that market of making loans to real estate investors. And we also saw that with the correction in the real estate market and the rash of foreclosures that created, that this was going to be an opportunity for real estate investors to buy real estate, on sale, basically, and for many of these homes that were in foreclosure, there was an opportunity to not only buy them but to remodel them and flip them for profit.
So you don't do loans for equipment or business loans, working capital, that sort of thing.
No, we
Strictly
don't.
Real estate.
And the products that I'm talking about, whether it's an individual note, which is also called trust deed investing, or a mortgage pool fund, for the most part, companies like Pacific Private Money who offer these investment products to the public, most of us, certainly at Pacific, we only do real estate loans. And for the most part, most of the product that's available out there are just simply a loan secured by a property, by a borrower. I mean, just like a bank loan from Wells Fargo or Bank of America, there's very little difference between the loans that we make and how we paper them and how they're recorded. There's very little difference between a loan originated by Pacific Private Money and a loan originated by Wells Fargo or Bank of America. There really is, in fact, there's really no substantial difference whatsoever. The loans are funded through a title company. There is a lender's title policy. The borrower has to sign all of these loan documents. There's disclosures on both sides of the table. Actually, there is one key difference between a loan funded by Pacific Private Money and a loan funded by Wells Fargo or B of A, and that is they generally tend to do 80% loan to purchase price, sometimes higher. We almost never go higher than 70%. That's the kind of the rule of thumb right now in the private money lending universe is that we generally don't go any higher than 70%.
Okay, so for the audience that's just starting to tune in, this is Mortgage Investing 101. I'm Edward Brown, your host, along with Mark Hahn, who's president of Pacific Private Money. Mark is explaining how he is earning over 8% on first mortgages. So once in a while there'll be a second, but mostly first mortgages in your mortgage pool fund. So being the listening audience here for a minute, I'm thinking, okay, so why are these borrowers paying 8%?
The reason they're paying 8%
or more?
for two reasons. The reason why a borrower would pay a high rate of interest, and I'll just tell you that a lot of the loans that we write at Pacific Private Money are for 10%. That's the note rate. It's 10%, not 4.5% or 5% that they would expect to pay at a bank, but it's 10%. And the reason, there's actually several reasons, but one of them is because we generally are only making short-term loans, and our market is guys that are buying, fixing, and flipping real estate. So they just have to budget in their numbers a cost of money, and so it might be they might need the money for 6 months, they might need it for 8 months, they might need it for a year. It depends on how extensive the remodeling is. But again, we make a loan to someone who's buying real estate. We give them up to 70% of the purchase price. They come in with the 30% down plus closing costs, and the remodeling budget, if any, is on them. They're coming in with that money too. They may have an equity partner, they may do a second, but
Well, why aren't they going to the bank and getting cheaper money?
they're not going to the bank because the banks aren't making those loans. They aren't. They really, the only loans you can get from a bank today, generally speaking, are consumer home loans. If you want to go buy a house for yourself, to be your primary residence that you're going to move into, the banks would love to talk to you, assuming that you've got a good FICO score and can prove your income. Bank lending today has become dramatically more difficult than it was 10 years ago, which reached the peak or the pinnacle of its ridiculousness in 2006, really, when anybody could, with a FICO score and 100% lies on the application, but stated. You could buy all kinds of real estate, and people did, and that's one of the reasons why we had the bubble, and that when the market crashed, we had all these underwater homes that people just let go. But again, when you participate in mortgage investing, you're providing your money to a company like ours, and we use that money to fund loans to real estate investors. Now,
Well, it's like when I put money in the bank in a CD or a checking account, the bank is taking my money and lending it out too.
right.
Same
So if you invest in the Pacific Private Money Fund, for example, that is a what we call a Reg D mortgage pool fund. It's registered and licensed, and it is the best way to explain an analogy for that fund is that it's like a mutual fund of real estate loans. So there's only two assets in the fund. It's either cash or it's a note secured by real estate. So it's a very, very simple process when you think about it. We collect investor capital. They fill out. They receive our private placement memorandum, which is also referred to as a PPM in the business. It's a prospectus essentially, and they fill out the subscription agreement, which is a few pages. They mail in their money or hand deliver it if they want to see the whites of our eyes, which a lot of our investors do. One last thing one thing that is noteworthy that I should say is that we're only allowed right now to accept accredited investor capital. So if you're interested in more information about the Pacific Private Money Fund, you do need to be an accredited investor. And the term accredited today means you have a net worth of at least $1 million, not including the equity in your home. So that we do make that distinction now. Or you make $250,000 a year for the last 2 years. So that's so there's a little bit of qualification there to invest in this. But again, if you want more information, we can obviously send you our prospectus, the list of loans that are currently in the fund. We've got all kinds of documentation that we've created to explain exactly how the mortgage pool fund works and the safety and security features that you receive, in addition to that great rate of interest, which at the third quarter, we're almost done with the fourth quarter, and so we'll know on January 15 what our fourth quarter distribution is going to be, but the third quarter distribution in our fund was at an annualized rate of 8.9%.
So if I invested, which I did, then I
Yes, you
earned
did.
8.9% on my money that was sitting in your fund. When we get back, we're going to talk about, as I mentioned, one of the things about how popular it is, and I'll give you an example. And then also we're going to talk about, it's not just the fact that real estate investors aren't getting loans from the banks, but the banks can't work fast enough. And every once in a while, you'll have a borrower who needs to close quickly.
Good
So,
point.
okay, so here we're going to cut to the first commercial break, and again, the theme is the movies with colors in the name. All right, this psychedelic animated film is based on the Beatles music, but it takes its name from only one song. What color is the place where we all live? The first three callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Their website is lighthouse4fun.com. Yeah, call
I had to think about that
yeah,
question for a
you have to
second.
think about it. Yeah, call 888-529-1134. That's 888-529-1134 to answer this question. This psychedelic animated film is based on the Beatles music, but it takes its name from only one song. What color is the place where we all live? 888-529-1134. That's kind of a hint, by the way. And make sure that you include your name and your email address. Speak slowly. Spell out your email one letter at a time. Don't touch that dial. Mortgage Investing with Edward Brown and Mark Lunt. We'll be right back.
Beautiful. Yeah, good point. So yeah, after you tell your story, let me go back and maybe I'll tackle it from a different angle to kind of explain how our product exists in this marketplace. Basically, real estate investors need capital. They need it fast.
Yeah.
They need it notwithstanding possibly damaged FICO scores from other real estate investments they may have made that went bad.
And even ones who have the best FICO scores, banks still
Yeah.
can't work that fast.
We provide that product. We charge them up the yin yang, and and our investors benefit. Why isn't somebody letting out 6% or 7%? I don't know why, but it's just that's the market for.
Well, because
hard money.
everybody's got to make a little money on it.
Yeah,
You got to make some scratch.
Gotta make scratch. That's right.
Got to get the vig.
That's right. I need the vig. I need a taste. It's a scratch, man.
All right, ready?
Okay. Yes, I am.
Well, welcome back to Mortgage Investing 101. I'm Edward Brown, your host, along with Mark Hoff, president of Pacific Private Money, the fastest growing private lender in Northern California. When we cut to the first commercial break, we asked this trivia question. Again, the theme is movies with colors in the name. This psychedelic animated film is based on the Beatles' music, but it takes its name from only one song. What's the color of Where We All Live?
We all
Live in a
yellow
yellow submarine. That
Yellow
is
submarine.
yellow. That
Think
is
about that
correct.
question. When you first said it, it kind of tweaked my
Kinda
head for a
tweaked it.
second.
Okay, so when we cut to the before we cut to the break, I told the audience that I was going to tell them about a story about why this is so popular. When I'm talking about this, I'm talking about mortgage investing.
Yes.
So I got an email from somebody who is in this business, and it was promising to pay only 8%, and it was in Sacramento, and it looked like a decent deal.
So it was a loan in Sacramento
A
that
loan in Sacramento.
that they had sent you a deal sheet on saying, hey, you
That's
want to
right.
do this loan, and if you're interested in funding it, we'll pay you 8%. How big was the loan?
It was $125,000.
It's about average. Was
Yeah,
it a
it's about
single family
average.
home? or-
Single family
Okay.
home, decent neighborhood, $200,000 value is what they said. So it's 60% loan to value,
That's a
which is
conservative LTV.
yeah.
loan to
So
value.
so far so good, right? So I literally got the email, and with less than 10 minutes later, I emailed back to say I'm interested.
Send me more info.
Send me more info.
Yeah.
I get an email back 25 minutes later that says it's been taken already by 2 different people, but if you're interested and something falls out, we'll let you know. So
10 minutes
10 minutes.
after you get the email.
Yeah, I mean, I barely had time to read the entire email, and I said, yeah, this is good enough that I'd like to invest, and it's gone.
That's amazing, and it's not unusual. I'll tell you that over the last several years, we at Pacific Private Money have experienced the exact same thing.
So what is an investor to do, Mark?
Well, that is why we created the Mortgage Pool Fund as a way for people who need that yield, want to participate in the high yields you can get through mortgage investing. Maybe you're a person who has invested in an individual note before, also called trustee investing. And even if that's your preference, that you would rather invest in an individual note, and some people have that preference, and there are reasons why some people like to do individual notes. The stark reality of it is that there are so many people looking to put their money in individual notes that they're really difficult to find. The quality ones go quickly. You can always find a note to buy, but the quality of those, they're not the A notes or even the B notes. They're going to be the C or the D's. Oftentimes non-performing notes, and that's a challenge. And so we created the Mortgage Pool Fund at Pacific Private Money because of the fact that I was getting more and more phone calls from people saying, "Hey, I've got several $100,000, and I've done private lending before. Do you have any individual notes?" And I would tell them no, because we are using our Mortgage Pool Fund now as a source of funding our deals, and so all of the best loans that come through our office, and we're funding anywhere between 15 and 20 loans to real estate investors per month, and the Mortgage Pool Fund gets the first look at those deals. So all the best loans go into the fund first, and then whatever. And there are other loans. We do more loans than the fund has capacity to do. And so we still do individual notes, but then I've kind of developed over the last several years a relationship with a handful of about a dozen very, very well-heeled private lenders. Some of them are retired mortgage professionals, and they can make up their minds very, very quickly. And so I don't actually need to go out into the public and do these mass email distributions
Well,
anymore
so
of my
they-
individual notes.
Well, also, they have known you long enough to trust you that you've done your due diligence prior to even bringing it to them.
Right, that's exactly right. So Edward, you hit it right on the nose that individual funding high quality individual notes today is not anywhere near as simple to do in terms of getting the product or getting access to the product as it was a few years ago. It's become very popular, and it's become popular because
Where else can you get 8% or
right,
more?
with safety and
Safety.
security features, which is basically a conservative loan to value secured by real estate. So
So let's get back also, to, if we could,
Yeah.
to why sometimes there are borrowers out there who have great credit scores, and the banks are very willing to lend the money, but there's a catch. The banks can't work fast enough, and sometimes these borrowers are getting fantastic deals.
well, that's one of the reasons you had asked a question earlier in the show, last segment, about why would someone pay 10% for money? Well, let's take a step back here. So, real estate investors have been having a field day ever since the real estate prices corrected, and I would say that since 2010 and 11, real estate's been on sale. Now, some might argue that, well, it's gone back up in a lot of markets, and that's true, but there are a lot of markets where it's still 60%, maybe 70% of the high, so there's still some bargains out there. In fact, we're funding loans, multiple loans every week to real estate investors who are finding these bargains. So there's a business model out there. These are contractors, these are rehabbers, these are real estate investors, these are guys that are out there looking for properties that they can acquire at a good price, improve it, and then flip it. They're not just buying it to hold it for 5 minutes and flip it. That's done. No one's made money like that, to my knowledge, in a long time. These are guys that are adding real value. Now, they need leverage, because a lot of these guys aren't sitting on $1 million worth of cash. Where do you get the leverage? You can't go to the banks. The banks don't, a lot of these guys, their credit isn't perfect because they owned real estate when the market turned, and some of them did short sales, and some of them had foreclosures. But these guys are good credit risk borrowers, number one. Number two, as you pointed out, the banks can't react fast enough. And in today's market, speed is what gets you the deal. So if you make an offer on a property, oftentimes my borrowers are out there making all cash offers, even though they know they're going to call up Mark at Pacific Private Lending and go, hey, Mark, can I get a 70% loan to help me buy this house? Of course, I say yes. Let's work on all the deals, on all the application and all the.
But from the seller standpoint, he's getting an all-cash offer.
From the seller standpoint, it's right. There's no financing contingency. There's no 4-week delay because you gotta do all this stuff. And oftentimes there's not even an appraisal requirement because we can have someone run out there and do a quick valuation for us in house.
What's the fastest that you can actually do a loan?
We did one 2 weeks ago where I got the call on Tuesday morning, and we underwrote the loan in 48 hours, funded on Thursday, and recorded on Friday. By Friday afternoon, that person had bought that home. So we don't like to do 4 business day fundings, but we can when there's a compelling opportunity. And I've got so many investors, plus the mortgage pool fund that has capital looking to deploy, that's what we're on the lookout for. We're on the lookout for opportunities to make a loan that makes sense at a conservative loan to value. We'll charge 10% on average because that's what it costs to get private capital today. I don't make that market. That's not my number. That's just what it costs in general in the San Francisco Bay Area right now to borrow privately. If you live in other states, that number is actually quite a bit higher. If you're borrowing in Atlanta, Georgia, you're paying 18%. If you're borrowing in Phoenix, Arizona, it's 15%.
So in theory, if some super wealthy guy came to you and said, listen, I only need 3% return, you could probably charge 5% to these borrowers.
I'd gladly. I just, hey, one of these days maybe I'll find someone like that I can give him, safety and security and pay him 3% or even 5% because I can try to lend that money out at 8%.
The funny thing is, it's not going to be really that much safer. I mean, it is from the standpoint that the payments will be lower for the borrower, but the LTV is going to be about the same.
Yeah, that's correct. So there's a third reason why we talked about speed is one, credit is another reason why a lot of my borrowers can't get money from a bank. But the third reason is that a lot of the real estate opportunities out there are not bank financeable for one reason or another. There's something wrong in one of the reports, or in a case that we're working on right now, the kitchen's missing.
All right, who took the kitchen?
Well, actually, it's missing because the guy that my client, my borrower client, my prospective borrower client is buying it from, he started a remodel and pulled out the kitchen and actually started to do a pretty good job. But then he ran out of money and other things happened in his life, and now he's just looking to get
He's
out from
kitchenless.
underneath it. Yeah, so he's got a kitchenless house that's he was in the throes of a remodel.
And the
so-
banks consider that uninhabitable.
Right, that's exactly right. So, broken remodels are common transactions for our buyers. Because again, there's always people that'll run around out there and maybe get in over their heads. Maybe they paid too much for it, or didn't really, they learned what they know in a real estate boot camp, but found out there's a little bit more to it than that. So anyway, again, the loans that we make, well secured, generally 70% or less, 10% note rates, of which, in the case of our mortgage pool fund, the investors are earning, we're paying the returns at about 8.5%. So let's use 8.5% for argument's sake, passively, and a couple of other really nice features about the mortgage pool fund that we designed it this past year specifically for the market in the Bay Area that we're lending on. And it's designed to profit from short-term loans that are paid back quickly. And when I say designed for that, what we do is not only does the entire note rate get paid to the fund for the benefit of the shareholders, but we put in half the origination fees that we charge the borrower also into the fund. So we call that the house share of the origination points, because the other half goes to pay our sales force. So with half the origination fees going into the fund, in addition to the interest as profit, what you have is you have a vehicle, this mortgage pool fund, that when it makes a loan to a flipper, and if he flips it in 90 days, well, we get the cash back and we loan it out again and create more origination fees, which again go into the pot. So it's a great vehicle. It's been very successful. We're very pleased with it. We've been doing a lot of great loans. We've already got paid back. I think we have our 5th loan paying back here in the next couple of weeks.
In the fund already?
Yeah.
Wow.
So that's and again we just launched it earlier in 2013. So it's a great vehicle. Again, if you're listening to the show and you're wondering what the heck is this show I just found by switching dials here, you're listening to Mortgage Investing 101 with Edward Brown and Mark Hanf. I'm Mark Hanf, president of Pacific Private Money. We are a private money lender, also called a hard money lender. We market for 2 types of clients. We market for great borrowers, real estate investors out there taking advantage of opportunities, and we also market for investors. We're always looking for new capital. We're welcoming people every week into our mortgage pool fund, and you can contact us by calling 415-883-2150. That's 415-883-2150. We also have launched a new website for our fund, and that can be found at pacificmoneyfund.com. That's pacificmoneyfund.com. But again, we just launched that, so it's not completely, not all the text in there is where I want it to be and where I intend it to be. So really, you're going to get the most value by either calling or shooting us an email, which you can find at the radio website or at the Pacific Money Fund website. Shoot us an email, ask for more information, and we'll just be happy to shoot you a PDF executive summary on how the fund works. We're very non-pushy. I mean, this is there's so much money out there. I have no doubt that we're going to raise the money that we intend to. We have a certain goal for the fund this year. We know we're going to get there, and whether it's with you or with somebody else, we'd happy to take your money. But again, we're not going to beg you or push you or harass you into investing with us. That's not the point. But the point is to expose you to this opportunity, this alternative investment opportunity that we call mortgage investing.
And when we get back, we're going to talk about not only just the risks of it, because there really aren't too many risks, but also how to get out. Because people are going to say, well, I don't want to tie my money up for 20 years or whatever.
Excellent point.
Okay. And then also, I'm anxious to hear the deal of the
Deal of the week, okay.
Okay. Here is our second commercial trivia question. And again, the theme is movies with colors in the name. This 1963 comedy stars Peter Sellers as a bumbling police inspector. The name refers to a rare gem, although it has come to be associated with Sellers' character. Which color is contained in the name of the gem in question? The first three callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. In fact, I think I remember Steve Martin did a remake of it.
You did?
Their website is lighthouse4fun.com. Call 888-529-1134. That's 888-529-1134 to answer this question. This 1963 comedy stars Peter Sellers as a bumbling police inspector. The name refers to a rare gem, although it has become, let's try this again, although it has come to be associated with Sellers' character. Which color is contained in the name of the gem in question? Call 888-529-1134 and make sure to include your name and your email address. Speak slowly, please, and spell out your email one letter at a time. Don't touch that dial. Mortgage Investing with Edward Brown and Mark Hoff. We'll be right back.
Trying to look for a deal we haven't already talked about.
Okay.
Akbar's mommy.
Yeah.
No.
Just make sure Marcos. Akbar's mummy. And I don't even remember seeing Akbar, the name Akbar in there.
It's actually Akgar, but he's a guarantor. She was the borrower, and he's a guarantor.
He's guaranteeing his mom's loan?
Yeah. Well, it's he's the mom's kind of the straw buyer, although she owns other real estate.
Yeah.
And it's funny how some people are not really sure why he buy it in his name, but the original contract was in her name, so they never transferred it.
Yeah, I guess if you're gonna tell the bank next time, now make sure that it really goes out. The wire really goes out. How much is in the fund now?
It's like 2.4, 2.3 and change. Yeah, like I said, it's just been since the launch party. We only had one new investor, but I've got several that are poking at it now.
Well, I talked to Mr. Clark yesterday.
Oh, yeah.
So he's doing his IRA.
Yeah.
Is that the 25 one? Or is he the?
No, I think Steve Jagoda
Oh,
is
yeah.
the 25 guy. Clark might be 100.
Yeah, I didn't ask him how much. I just figured it. So maybe this guy. Okay, how much is left here? 14 minutes.
These happy holiday emails are so annoying.
And
Delete.
just say Merry Christmas, you know?
Well, it's not even that so much. It's just I don't send them out because I just don't think
Yeah,
we all get too many emails already.
that's true.
How many minutes?
14.
Oh, good. All right.
Okay, so we get into Deal of the Week and then risk. How's that?
Yeah, I'm still. We talked about. I think all of these we might have brushed on before, but this one we can't recycle one. There's.
Are you talking about Akbar's mommy?
We did, but it's been a while, so I'm gonna go ahead and because actually several of the ones that I've done are very much like that. They're just they're short sales.
Okay.
So we can talk about how are these guys making money on these
Okay.
firms.
Yeah, because this short sales aren't as bad as they used to be from the standpoint of how long they take.
Right.
It's a lot shorter. Here we go. Welcome back to Mortgage Investing 101. I'm Edward Brown, your host, along with Mark Hahn, president of Pacific Private Money, one of the fastest growing private mortgage investment firms in Northern California. When we cut to the second commercial break, again, the theme is movies with colors in the name. Here it was, the question. This 1963 comedy stars Peter Sellers as a bumbling police inspector. The name refers to a rare gem, although it has come to be associated with Sellers' character. Which color is contained in the name of the gem in question?
Easy one, pink.
Pink for the Pink Panther. That is correct.
I didn't know the Pink Panther was for a jewel though.
Yeah,
I was
because
wondering
it was a
about
pink
that.
diamond.
Yeah.
So, Mark, give us the latest deal of the week.
Well, actually, let's see. This is we had a pretty busy week this past week, and so we're trying to get as many deals closed before the holiday as possible. And the holidays right now, we've got Christmas and New Year's both falling on a Wednesday, which really just chops up the week. And in our business, where it takes sometimes you need 2 or 3 days in succession to be able to actually close a deal. You get the loan documents to the escrow company, they go in there, they sign the loan docs, then maybe you fund the following day via wire, and then usually the escrow companies need to hold that money for 24 hours. So then day 3 it goes on record. Well, how do you do that when you've got a holiday on a Wednesday? So you got a Monday and a Tuesday, and then you got a Thursday and a Friday. So it kind of sits over, over the holiday, over one of the holiday days. So it's kind of messed us up a little bit. But I think we're closing 9 files by Tuesday the 24th, and
Wow.
among those are actually, rather than go into a specific deal, because with several of the deals are very similar, and they are short sales. They are the buyer of these, all these. I think we have 3 short sales that are closing, and all 3 of them were buyers that had been in contract for actually quite some time. They had put offers on these properties. One was over a year in contract.
Wow.
The other 2 were around 5 or 6 months. I know we've talked about on previous shows how short sales are happening faster oftentimes these days, and that's true if you are in a short sale as a seller. If you're in a short sale opportunity or position now, I guess it's an opportunity for a buyer. It's not really an opportunity for a seller. But
Give the 10-second explanation of what a short sale is.
you are selling your home for less than what you owe on it. Oftentimes, this is the case when you bought your home in 2004, 5, or 6. Maybe you have a first and a second because you were taking advantage of the fact that you could get
Free money.
free money, nearly free money and nearly 100% financing. And so these are people who, were able to hold onto their home or wanted to hold onto their home, notwithstanding what's happened in the market the last 5 years, because not everybody walked away from their upside down home. In fact, there's still 2 million homes in California that are considered at or near underwater.
Wow.
So it's so it's not over yet. There's still a lot of there's going to be a lot of short sales in 2014 and 2015 still, and there were a lot of short sales in 2013. And so we've got situations where the banks are willing to sell the house, oftentimes below fair market value, and you wonder.
Or they're willing to accept a payoff.
They're willing to
Yeah.
They're willing to accept a payoff of less than what's owed on it. They're going to allow the owner of the property to sell it for slightly less than fair market value. And you would wonder, well, why on earth would they do that? And the reason is because it's kind of known in the business that it oftentimes does take a while for a short sale to get approved. So
Also, they risk that the borrower might file bankruptcy and just cost more money and drag it out even further.
right. So there's a short sale
Cut their losses.
discount. It's not as big as it maybe was a couple of years ago, where oftentimes the short sale discount could be as much as 20%.
Yeah.
Now it could be 5% or 10%, but it's still a real discount. And in each of these situations, the condition of the property was not perfect. Still a relatively new house, built in the last 10 years, but in need of paint job, maybe paint carpet. In some situations, one of the sales we have, they're going to go and put hardwood floors in there. It's got carpeting that's was the cheap carpeting that they bought from the builder, and it's just it's been ruined after 8 years, and so they're going to go and put hardwood floors and doll it up really nicely, put it back on the market, and they're not going to make a killing. Nobody's really making a killing in this market. The fix and flip market is a great opportunity for a lot of people still today to make a good living, but you don't make a killing. You're not making $100,000 usually profit per house.
Well,
not in the
give
Bay
us
Area.
the one you're thinking about.
That's in
Give
San
us
Francisco.
real-
I met, if you're some of my fix and flip clients in San Francisco, but they're putting in a ton of money, and so they're turning around and selling it and making several $100,000 profit. But
Well,
That's,
give us
that's
the
the
one.
exception rather than the
Okay,
rule.
the one that you were thinking of. You said you got a few of them. Give us real
Well, there was
numbers.
one. Well, for example, in Elk Grove. Well, you're familiar with this. You helped work on this with us, Edward. Elk Grove. It was a house built in 2005. The loan on that amount was, what was the? I don't have the numbers in front of me. I'm sorry.
Is it the 217?
Yeah, the two right. So 217 was the loan. I think that they were buying it. There was 70% of the price they were paying for it. So, and again, the numbers aren't really important. It's just the fact that it was actually a pretty good size home. I want to say it was close to 3,000 feet, built in '05, 4-bedroom, 2.5 bath, Elk Grove, one of the newer neighborhoods that sprouted out of nowhere, like a lot of neighborhoods did in
So
the
they bought it
early
for
to
about
mid 2000s.
315.
Yeah, it was
something like that.
310. That was it.
$310?
Yeah, it was
So
the
they bought it for 310, and how much are they going to put into it?
Probably on that one, that's going to be mostly cosmetic. I don't think they'll put more than 25,000. That's the one that they're going to do the hardwood floors in it. So
Okay.
they're going to put that back on the market.
So they'll be into it for 335. Let's
Right.
say. What do they expect to sell it?
Something in the high threes. You know, they're going to probably put on the market for 399 and maybe get 3.8. Again, they're not going to make a killing. You know, again, this is a very quick flip. I mean, I think they hope to put 20,000 in their pocket. Again, real money depending on your financial situation. And this particular buyer is a single man. He and his mother together were buying the property, and they do a lot of investments like this together. And
They're
so
a repeat borrower, aren't they?
they are, yeah, absolutely. Well, we do work with a lot of repeat borrowers. So
Okay, so what are the risks?
so
And again, to remind the audience, you're listening to Mortgage Investing 101 with Edward Brown and Mark Honf. And if you like what you hear, you can call Mark Honf at 415-883-2150. Go ahead.
absolutely. So what are the risks? So we're talking about mortgage investing, where we're telling you that you can, with safety and security features not found in other investment options, you can earn 8% or more on your money. So the two things we want to cover here: what are the risks, and then what's the liquidity? How do you get your money back out of these things? So the risks. Well, the risk is that we fund a loan at 70% of the purchase price. Borrower comes in with 30% down plus closing costs. Usually we figure, rule of thumb, they got to come in with 35% down because we charge points, usually 3 points plus title and escrow. So it's going to be about 5% of the transaction is going to be closing costs. They're coming in with all of that, and then in addition to that, they're very likely going to have some remodeling money because again, we're mostly making loans to people who are buying for a short term. They don't intend to hold the property long term, or if they do, they're going to pay us off with a bank loan. That's an exit strategy, as we call it, for some of our borrowers. But again, we're talking about the risk. So they start doing the remodel, let's just say, and they either run out of money or they discover something and they stop, and suddenly you got a broken project. They're not serviced. They're not making the loan payments, and we have to foreclose. Well, okay. Well, our exposure is 70% of what they paid for it. Even if they started digging into it and tearing it apart, and the value is arguably less than what they paid for it, we still have a large, 30% protective equity, a cushion there, as you might say. And so, and we have not had to do this yet. I'm going to point this out. We have not had to foreclose and take back a borrower's property, at least not in the mortgage pool fund. I've had some early on, some of the loans we did in 10 and 11.
I mean, it sounds like you could actually make more money.
You
if
can.
did
That's
it.
the whole point. Is that the risk really isn't. There really isn't much risk out there to this type of investing. Now, it's less risky if you do a mortgage pool fund. It's more risky if you invest in an individual note, unless you're very, very comfortable with the collateral and maybe even with the borrower, because you get to look at his credit report and all that stuff. But as long as it's a place you wouldn't mind owning, and in fact, a lot of my individual note investors, that's the way they decide whether or not to invest in a note, is if the answer to the question, would I like to own that property for the money that I'm lending, is yes, then that's one of the criteria they use in deciding to make a loan. And in fact, I know several people whose entire investment portfolio they have created as a result of making loans that they later foreclosed on. Now, I'm not advising that as a strategy for acquiring real estate, but I'm not going to be a judge of moral character here. If that's how you've acquired your cachet of real estate.
You're twirling that mustache there, Mark.
Now, if you invest in the mortgage pool fund, You know, we as the fund manager, and I've got so many contractors who are clients that, you know, if and when we have to foreclose on a property and then complete the remodel and then sell it for a profit, it's not going to be a problem. It's going to be a piece of cake. You know, that's just not an issue as I see it. What are the other risks? Well, to be honest with you, there's just not a whole lot of risks. I mean, if you say, well, what if we have another crash in the real estate market? Well,
Possible.
could real estate prices go down 30% again, like they did on average in the years between 2007 and
Possible,
2009?
not probable.
Possible, not probable. What would have to have happened in the economy to create such another
A severe
catastrophic?
depression.
Right. So nothing you invest in, even money in the mattress, is not going to be safe if we see in the next few years another 30% or 25% depreciation in real estate. So I just don't think realistically, when you look at all of the economic variables that are out there, short of a catastrophic, unforeseen event, I don't see real estate dipping more than 10%. And I'm not predicting it will go down in the Bay Area at all. But if we did see a dip, I would be very surprised if it was more than 10%.
And you're still covered because you have
And
lots
we're
of like
plenty of cover. That's why we solve for a 70% loan to value maximum. Because again, we don't want to expose ourselves to a real estate downturn and then find people walking away where we have to.
Well, you have personal
foreclose.
guarantees on many of the loans too, don't you?
We do, yeah. I mean, if they're borrowing in the name of an entity, yeah, we don't let just people borrow in a corporation and then think they can walk away. That doesn't quite work. We do collect personal guarantees.
So we have just a couple of quick minutes left. About exiting.
The exit strategy. So the mortgage pool fund has a 2-year investment minimum term. We chose 2 years because that seemed to be an amount of time that a lot of our investors have a comfort level. Sometimes a year is too short, and sometimes 3 or 4 years is too long. So we made it 2 years because again, that seems to be the most common request from us is for a 2-year note. And also that we don't want people to treat this like a money market account. I mean, we have a real business model making loans, and I don't want people putting money in and then thinking that 6 months later they can take it out. Now, you can. We just have a redemption fee in the first 24 months, and it starts out at 5%, and it goes down every 6 months. It goes down a point. So by the last 6 months, if you needed to get out early, if you needed to redeem your money, we would do so, but we would charge you 2%. So you can redeem within two years. If you own an individual note and you're wondering about liquidity, there are a lot of ways that you can sell to another investor.
You have to probably sell at a discount though.
Normally you do, yeah. Normally you do. So
with even if people want to get out in 2 years, you have given them enough interest. 8-point-something% plus
Right.
8-point-something% plus 2%. I mean, that's still a pretty good deal.
it is. If you need to get your money out quickly, you can do so.
How do people get a hold of you?
Pacific Private Money, we're at 415-883-2150. We're in Marin County as our office. Or go to our new fund website, which is at pacificmoneyfund.com. That's pacificmoneyfund.com. You'll see information about our team and the type of loans we do. And plus you can get our email address and phone number there too.
And you can always go to the website, Mortgage Investing 101.
Yes.
So tune in next week to Mortgage Investing 101. We're going to be giving away more free vacations for answering trivia questions and giving more valuable information about mortgage investing. Thanks for listening. I'm your host, Edward Brown. And on behalf of Mortgage Investing 101, so long. We'll catch you next week. 5 seconds to spare.
Nice.
And Mr. Klima?
Quick.
No, I thought.
So trying to